Welcome to the presentation, which is titled, Is the Investing World Getting Smarter? And today, I will be looking at smart beta products and how they're increasingly becoming a significant part of client portfolios. Just some background on the team. We have Lofty Botha and myself, Imtiaz Mohammed Alli, who are the two portfolio managers. We've been managing absolute return funds, index tracking funds, as well as smart beta portfolios. We launched our first two smart beta funds in April of 2017. And if we've had phenomenal success on those portfolios, not only in terms of asset growth, but more importantly, in terms of performance as well. And in August of 2021, we launched our third smart beta fund, that being the Momentum Quality Fund. Further to this, we have also partnered with a global asset manager, that being Robeco Asset Management, who are based in the Netherlands. As far as the agenda for today's presentation goes, I will first look at exactly what is smart beta. Now, within the smart beta space, there are a number of factors which one can invest in. However, I will be looking at the four main factors that most investment managers use when it comes to smart beta portfolios. Thereafter, I will look at the growth of the smart beta industry. Then, we'll unpack the role that smart beta plays in investing, and I will also show how smart beta funds can complement existing strategies out there. And I will end off the presentation by going through the smart beta offerings that we have at Momentum Investments. Okay, so what is smart beta? So it depends who you speak to. Some might refer to it as factor investing or strategic beta. However, according to smartbetafieldguide.com, the term was first coined by a consultancy company called Towers Watson. And they indicated that an investment strategy should have some basic characteristics. That is, it should have a systematic methodology, it should be transparent, and it should have low fees. Now let's look at smart beta from that perspective. Firstly, with regards to systematic methodology. Smart beta funds are constructed using a systematic, rules-based approach for constructing the portfolio and for selecting shares. With regards to transparency, investors in a smart beta fund know exactly what the strategy is behind the fund, as well as what the constituents are in the fund. And when it comes to low fees, the fees that you pay on smart beta funds are lower when compared to actively managed portfolios. And because shares are weighted according to investment styles, you find that it lowers your risk, as a chance of having an overvalued share with a high market cap will not find its way into a smart beta index. So within the investment world, where does smart beta fit in? So on the left-hand side, we have passive investing. And on the right-hand side, we have active investing. Now with passive investing, you're paying a lower fee, but you're getting a market return. And on active management, even though you pay a higher fee, your target is to outperform the index. And that's where smart beta comes in. It's giving an investor the benefit, firstly, of paying a lower fee, and you also target to outperform the index. So giving an investor the benefit of both worlds between passive investing as well as active management. As mentioned earlier, within the smart beta space, there are quite a number of factors that one can invest in. I will now go through the four most common factors in the smart beta space. Firstly, we have the momentum factor. So what is the momentum factor? You probably heard of the saying, the trend is your friend. And that is exactly what the momentum factor is about. That shares which have performed well in the past will continue to perform well in the future. And when looking at momentum shares, a portfolio manager would typically look at shares that have performed well in the last 3 to 12 months. Now, does a momentum strategy actually work? So it has been documented in a 1993 study in the Journal of Finance how the momentum strategy generated significantly higher returns in the overall US market from 1965 to 1989. Furthermore, it was shown that the momentum strategy does not only work in the US, but in other markets as well, including emerging markets like South Africa. The next factor I will go through is the quality factor. So companies which score high on the quality factor are well-run companies which have stable balance sheet and also higher profitability relative to their peers. Also, when it comes to quality companies, you find that they have lower debt levels. Now, why is that important? You find as an economy contracts, quality companies can weather the downturn much more better than a company that is more highly geared. Next, we have the value factor. So value investing has been around for a very long time. And the concept behind value investing is that shares which are cheap according to certain valuation measures would outperform shares which are more pricier. Sometimes what happens in a market, you find that the market overreacts to bad news to a point where share prices are not aligned to the fundamentals of the company. And smart beta investors can take advantage of this. And when looking at value shares, a portfolio manager would typically look at your ratios such as your price to earnings ratios, your book value, free cash flows, as well as high dividend yields. Next, we have the low volatility factor. As the name suggests, it's companies whose share prices have a lower volatility compared to other shares. And with low volatility shares, you find that they give an investor a smoother return profile over the investment period. Also, with low volatility companies, you find that they don't participate as much in market downturns. Now, we all know that these factors exist out there, but there are reasons why these factors exist. And there are a number of reasons. However, I will just go through 3 of them. Firstly, there's the risk premium, where investors need to be rewarded for the risk that they take. Let's take value as an example. Sometimes you find shares are cheap, but they can be cheap for a reason. In fact, they can be cheap for a very long time without any value being unlocked. And for this reason, you find that value investors need to be rewarded for this risk premium. Then we also have the behavioral bias, where, for example, growth stocks are preferred while value stocks are ignored. The other reason could be a structural issue, for example, liquidity. So even though a share might offer significant value, it will be difficult to accumulate in larger investment portfolios. And smart beta investors can take advantage of these factors existing in the market. So the benefits of smart beta funds. Smart beta funds are not complicated and they're simple to understand. Firstly, they follow a data-driven approach. Now, this data is widely available and it's not costly to obtain. In fact, most portfolio managers, if not all, will already have access to this data through the existing systems which they have. Compare this to active management. An example, the portfolio manager might have a team of analysts that analyze companies in quite detail. And these analysts need to be compensated for the work that they do. For this reason, you find that active funds have a higher fee when compared to smart beta funds that is data-driven. Then when it comes to share selections, there's always a possibility that a portfolio manager might have a certain bias towards either a certain share or shares or even a certain sector. And this could influence the portfolio construction process. However, when it comes to smart beta portfolios, because they're constructed using a systematic rules-based approach, you find that there's no bias where the portfolio manager makes individual share selections. Also, at Momentum, we don't follow a set and forget approach when it comes to investing. Once the portfolios are constructed, they are consistently monitored, and where necessary, changes would be made in line with the portfolio construction process. To give an example of this, you might have a value portfolio, and within there might be 1 or 2 shares which can outperform the market in a very short space of time, to a point where it's no longer a value share. And this needs to be addressed accordingly. So overall, you can see when it comes to smart beta portfolios, you're not only getting the benefit of diversification to the different factor styles. However, you also, in terms of the portfolio construction process, it's very different when compared to actively managed portfolios. Okay, let's take a look at the growth in the smart beta space. The chart I have here is the smart beta ETF market in the US. And in 2000, the first 2 smart beta ETFs were launched. However, fast forward 20 years later, you find that the total assets under management in the smart beta ETF space is around 1.5 trillion US dollars, representing approximately 20% of the ETF market. Furthermore, this growth has come from individuals as well as state pension funds. Now, just to break down this growth a bit further, 54% of this growth has come from client flows, while 46% of the growth is actually asset appreciation. So quite a nice balance in terms of asset growth as well as client flows. Furthermore, if you look at this graph for the Australia, Asia, or even Europe, you find that the smart beta ETF market is showing a similar growth trend. Now the question is there a need for an additional product in the market? Just looking at this chart, this is the percentage of active managers in a particular year that failed to outperform the S&P 500 index. And this dates back all the way to 2001. And on average, you'll find that around 65% of managers fail to outperform the index, which is quite staggering. For this reason, you find it is important to have an additional product to your portfolio, like smart beta, where firstly, it can give you the benefit of diversification, it can lower your risk, and potentially enhancing your return. Okay. Also, in terms of smart beta growth, the chart I have here is from FTSE Russell, and they've been doing the annual smart beta survey from 2014 onwards. And the question was asked, do you have an allocation to a smart beta fund? So the last survey that they did, they surveyed 178 asset managers, managing over $5 trillion of assets across North America, Europe, Asia, and some other regions as well. And the response rate was, in 2014, around 30% of respondents had an allocation to a smart beta strategy. However, in 2019, that response rate had gone up to close to 60%. Furthermore, in 2016, the survey added an additional question, and that was, are you currently evaluating an additional smart beta allocation? And from 2016 to 2019, around 60% on average of these managers were planning to allocate additional funds to the existing smart beta strategy. And the only time you would want to allocate an additional funding to a strategy is if you've seen the benefits of it. So clearly, the growth of smart beta funds is still growing quite strongly. So we've seen the growth of smart beta funds globally, and it's quite strong. And I think it's important to look locally as well. So what we have here is the growth of the smart beta funds in South Africa. And from 2012 to 2016, we find that the growth has been quite static. However, from 2016 onwards, the growth in the local smart beta AUMs has been very strong. And at Momentum Asset Management, we've been a big part of this, launching our first 2 smart beta funds in April of 2017. So just to do a recap in terms of passive investing and active management. So with passive funds, we know you're tracking a predetermined index and you're paying a lower fee. And as shown earlier, you may outperform some of the active strategies out there. Then we have active management, where your aim is to outperform the benchmark. However, because of the detailed investment research that is done behind the scenes, you find that you're paying a higher fee for that. And also, because of the possible portfolio manager bias, you could have a higher portfolio risk in terms of share selections. And the beauty of smart beta funds, you can see you're paying the lower fee, and you also have the potential to outperform the index. And with regards to lower risk, the lower risk in a number of ways. Firstly, through diversification, there's no portfolio bias when it comes to share selections. And also in terms of the portfolio construction process, you find it's very different when compared to actively managed portfolios. So I've spoken a lot about fees and how important are fees when it comes to investments. The chart I have here is from the US Annual Fund Fee Study. And you can see over the last 10 years specifically, the cheapest 20% of funds received net inflows compared to the remaining 80% which received net outflows. So clearly the demand for lower fees are quite strong when it comes to investing. Furthermore, in the remaining 80% of funds only received a small percentage of inflows in the last year. So why are fees so important? What is the impact of fees? Now, within investments, markets are out of one's control. However, there are certain aspects of an investment that one does have control over, and fees are one of those aspects. The portfolio management fee that one pays can be vitally important, as the long-term impact between a portfolio with a higher fee can be very different compared to a portfolio with a lower fee. What we have here is two hypothetical portfolios, where the one portfolio A, has a management fee of 1% compared to portfolio B, which has a management fee of 0.2%. What you find is that obviously portfolio B would outperform because of its lower management fee. However, what is the impact of that? You can clearly see the effect of that of the difference is quite staggering over the long period. In fact, over 20 years, you find that the benefit or the difference between the two portfolios is almost 1 million rand. And that's exactly the same as the initial value of the actual investment. Now, why is that important? Is that this is a chart of only 20 years. And you find that the longer the period, the bigger the differential between the two portfolios. And keeping in mind that the average person will work at least 30 years of their life. So the impact of fees can be quite important when it comes to investments. As I've mentioned earlier, smart beta funds can complement existing strategies out there. And this is what I'm going to show you now. Currently, we have a portfolio relative to the capped Swix index. Now, what I want to highlight is the largest drawdown from the index, and that is around 22%. And the problem with this is when an investor sees such a large drawdown, they tend to panic and they start making changes to their investment portfolio. And this can be drastic because the long-term benefits of staying invested is very important. What you find is that an investor might decide to switch to a portfolio which is doing much better. And in doing so, he might incur additional fees, firstly. Secondly, he locks in his losses. And thirdly, there's no guarantee that the fund that you're switching into will give you the same benefit as it has in the past. And what you want to do is reduce this volatility as much as you can. And the way to do that is by the inclusion of a smart beta strategy, as an example. Now, assuming you add a smart beta portfolio to the existing strategy, you find that your volatility has the potential to go down to 12% if the smart beta fund can just do around 1% or just over 1% outperformance over the index. This gives an investor much more better comfort, and the chances of switching their portfolio and making changes is drastically reduced. Now, as with any investments, markets move in cycles, and it's no different when it comes to smart beta portfolios. As you can see by the study done by Momentum Investments, the different factors can perform very differently over time. However, the trick is to remain invested. Once you blend the different factors, you find that your return is much more smoother over the investment period. And this is quite a nice benefit when it comes to smart beta, is that you can invest in a multi-factor fund or take the multi-factor approach. So what is the multi-factor approach? It's basically combining the different factors to give an investor, firstly, a much smoother return profile. Now, the way to construct a multi-factor fund, you can do it in two ways. An investor can get exposure to individual factor funds, or alternatively, invest in a multi-factor fund where the portfolio manager would construct a portfolio from the bottom up by combining shares which have the factors of, for example, value, momentum, and quality. And within smart beta space, multi-factor funds have been growing quite strongly, as you can see on this chart. In 2008, the multi-factor portfolios were roughly under $10 billion US. However, until recently, that had grown to around $65 billion US. Furthermore, if you look at Europe and the rest of the world, you can see smart beta has started growing quite nicely as well. Okay. At Momentum Investments, in terms of our smart beta offering, we launched our Momentum Fund and Value Fund in April of 2017, and in August of 2021, we launched our third smart beta fund, which is the Momentum Quality Fund. What I want to highlight here, which is quite important, is the total expense ratio between these three funds. It's quite a strong or low total expense ratio, which is what investors want to see. And on the left-hand side, we have the Momentum Core Equity Fund. Now, the Momentum Core Equity Fund follows a multi-factor approach by investing in the individual factor funds. Furthermore, this multi-factor fund also includes, as part of its investment strategy, an allocation to an index. So as you can see, you can construct a multi-factor fund in various ways. Just with regards to our performance, the Momentum Trending Equity Fund since inception has on average given over 3% above the index since launch. And similar thing with the Momentum Value Equity Fund. The next fund I want to show is the Momentum Core Equity Fund. And as I mentioned, this fund follows the multi-factor approach. And what's interesting is that if you compare this return to the previous two returns, you'll find that there's less volatility in this fund because it's following the multi-factor approach. And because it has a part index allocation, it also lowers the volatility in the fund, giving the investor a much more smoother return profile over the investment period. So the question then, is the investing world getting smarter? Definitely yes. Firstly, with smart beta funds, we have the potential to outperform the benchmark. And you're doing that through lower risk, lowering your risk through diversification, lowering your risk also through in terms of the portfolio construction process. You're paying a lower fee for all of this because it's a data-driven approach. Also in terms of objectivity, you find that smart beta funds cuts out the objectivity because the portfolio manager does not make individual share selections. So thank you for your time and have a good day further.